Well, I'm the Cardinal.
And I'm the Hill, Cardinal Hill.
Yeah, my name is Jesse Harris, CFP, and I want to talk to you about Charitable Remainder Trust today. And we've got a sheet in front of us, mainly because this is a highly legal subject, and we may want to make sure we stay on topic. But as your wealth management team, this is something that we really like to quarterback. So we work hand in hand with your attorney as well as your CPA to figure out if this is a viable solution for you, and if it is, what's the best way to structure it for you. So with that said, I'll get into it. Charitable Remainder Trusts, they can be referred to as CRATs or CRUTs. We'll go into a little more detail in a second here. But all they are is an irrevocable trust that allows donors, they're called grantors, to give money or property to charities while also retaining an income stream. The grantor, or someone of their choosing, can receive income for a term of up to 20 years or for your life. And they can be non-charity beneficiaries that are receiving that income. However, at the end of the term, which can be the end of life, at least one charity will receive the remainder, hence the Charitable Remainder Trust aspect, will receive that benefit from the trust.
So Charitable Remainder Trusts, I'm just going to start calling them CRTs. They can be created and funded during the grantor's life as what's called an inter vivos trust, or they can be funded at death as a testamentary trust. So that's one core difference. Inter vivos CRTs are predominantly used to provide income security to the grantor and the grantor's spouse, where testamentary CRTs are typically used to provide a benefit to heirs and reduce the grantor's taxable estate. Provided that the CRT complies with all the IRS requirements, the trust will be tax exempt, and the grantor is eligible for charitable contribution deduction based on the present value of the remainder interest when the trust is funded. A lot of complexity there, I know, a lot of math, but there's a portion of it that's potentially tax deductible. And then distributions out of the trust to the income beneficiary are taxable using a 4-tiered accounting system specific to the CRT. Think of them as 4 different types of buckets. And so though the trust itself is tax exempt, it tracks activity into these 4 buckets. So the first bucket is ordinary income, which is like dividends and interest. The second bucket is capital gains, so when you sell something for more than what you bought it for in general. The third bucket is tax-free income. That would come through things like municipal bonds. And then the fourth bucket is the return of principal, the amount that you put in originally. So distributions will pull from bucket number 1 first, so ordinary income first, and then it will drain the capital gains bucket, and on it goes until finally it's withdrawing from principal.
Yeah, and broadly speaking, as I said, there's 2 types of CRTs. They're referred to as CRATs and CRUTs. And the first one is the Charitable Remainder Annuity Trust. That's where the CRAT comes from. Annual distributions of income beneficiaries are represented as a percentage between 5 to 50% of the initial contribution to the trust. And it is used to fund so those assets used to fund the trust, that's the 5 to 50%, and the payout is fixed. So this is a huge difference between the other side of it. The payout is fixed, so if the trust earnings are inadequate to meet whatever the fixed amount is, then they will start to draw down principal of the assets. Okay, so additional contributions to the CRAT are not permitted. Like this one's locked down. So you start pulling principal, it could completely deplete the asset. So these are better typically for folks that are of the older, more seasoned variety grantors. And so then the CRUT, which is again the Charitable Remainder Unit Trust, the payout is variable. So that's a massive difference. It's not fixed. Percentage amount can still be that 5 to 50% of the current fair market value of the assets, but this can be reassessed every year. So the principal amount can be reassessed, and then if it's a 5% of that principal amount, then it will go up or down depending on where the principal went in that given year. And lastly, these are typically more beneficial for younger folks, as it's not going to deplete the principal, or it cannot deplete the principal in some occasions.
Okay, so let's summarize, because I get confused with this stuff at times. So everything Jesse just said is a type of CRT. So let's break it down like a fraction. So really simply, CRUTs, the unit trust, charitable remainder unit trust, the payout is variable. So each year the trust is reassessed and the payout can change. Additional contributions are allowed. So this is maybe a more flexible vehicle, if you want to think of it. You can keep funding a CRUT over time. Because of that, it's typically a best use case for a younger grantor, someone that's accumulating wealth, they're still working, or there's some flexibility in their life. Contrast that with a CRAT. The CRAT, the Charitable Remainder Annuity Trust, is typically for older folks because the payout is fixed. So you kind of have this line in the sand, and once you set it, it's there for life. You can't contribute anything else to it, and so for that reason, it's a good planning vehicle at times for older participants. So those are the two broad categories. There are a couple of specific types of specificities that we want to go into. And so I'm going to read these because this is real technical. So a net income CRUT, or a NIMCRUT, enables the trustee to distribute an annual payment that is the lesser of the unit trust value in that year, or the net income earned by the trust in that year. Net income can be defined in the trust document or state law. So more specific options based on the income on that nuanced type number one. The second type is referred to as a NIMCRUT, which stands for net income makeup CRUT, or Charitable Remainder Trust. You can see why it's a little tongue-tied talking about these things. This is a variation of a NIMCRUT. The net income in a given year, if it's less than the unit trust amount, the trust enables the difference to be made up in future years if the income exceeds the unit trust amount. So we're into CRTs, CRUTs, NIMCRUTs, and now NIMCRUTs is a specific type of that. In the weeds, Jesse, take us one deeper.
The flip charitable remainder unit trust, or the flip CRUT, the way that these are built is they are structured first as a NIMCRUT or a NIMCRUT that flips to a standard CRUT that we already talked about upon a triggering event. So triggering events can be a lot of different things. They can be marriage, they could be divorce, they could be retirement, or being able to sell an illiquid asset is what triggers it. So there's a lot of things that you can build in there. But this is often used for donors that are wanting to maximize the upside growth of the trust to receive a greater income in the future. And again, typically when we're talking CRUTs, when you hear the U in there, we're talking for younger people. So, but they're really great. They can serve a massive purpose. All of these obviously are going to be built for folks that are more charitably inclined, that would like to be more philanthropic. And again, I would say we like to, as your wealth management team, be the ones that are making sure that we're sitting down with the lawyers and the attorneys and the CPAs to make sure that this plan works really, really well for you.
And then really tailoring that investment strategy to some of these nuances, because there really isn't one size fits all,
There really
especially when you layer in some of these legal issues. So thanks very much, and please give us thumbs ups and subscribes and all the likes.